APAC's asset and wealth management industry recently saw local, regional, and global banks release their 2Q figures, with Asia an impressive contributor for many. Singapore consult on a new single-family office framework, Hong Kong upgrade licenses for crypto exchanges, and several developments among fund and fund managers in China. Let's take a deeper look at these, as well as other headlines and developments. Starting off in APAC, amid a flurry of press releases, local, regional, and global banks have announced their earnings reports for the first half of 2023, and the Asian wealth businesses of many have seen substantial growth in assets, profitability, or both. So, in no particular order, HSBC, a British financial institution with historical ties to Hong Kong and China, saw global new invested assets in its wealth business soar $34 billion, with $27 billion of this coming from Asia, and over 35% of this segment sourced from outside Hong Kong, its regional stronghold. Further, Hong Kong, Singapore, and Taiwan saw pre-tax profits more than double, and all markets in Asia saw increases in their pre-tax profit year on year. Revenue from the British Bank's Wealth and Personal Banking division rose 41% year on year to $7.2 billion, and pre-tax profit nearly doubled from the previous year to $3.3 billion. The Wealth and Private Banking division saw a 21% year-on-year increase in revenue, and total wealth revenue, which includes asset management and life insurance, reached $3.9 billion, up 16% year-on-year. Group CEO Noel Quinn stated that the bank had, yet more, ambitious plans for its China business, planning to more than double its advisory staff headcount over the next few years to 3,000. In other news, HSBC's asset management division is looking to take majority control of its Chinese fund management company joint venture. Its Chinese insurance brokerage recently received regulatory approval to sell funds. It re-entered India's mutual fund market following the $425 million acquisition of L&T Investment Management in late 2022, and it recently re-entered India's private banking space. Whilst the financial results are very strong, with $8.77 billion in pre-tax profit generated over 2Q23, beating forecasts of $7.96 billion, and this, coupled with the announcement of a $2 billion share buyback, raising the total for the year to $4 billion, and a circa $4 billion special dividend, certainly serve as a strong rebuke to those that were agitating for a breakup of the bank in recent times. The fact that APAC accounted for pre-tax profit of $5.07 billion and drove a substantial portion of the wealth management business may serve to further embolden those that led the divestment charge, namely Ping An, a Chinese financial conglomerate. Whether we see these calls resurface will be interesting to see. Next, DBS, a Singapore bank, saw 2Q23 net profit of 2.7 billion Singapore dollars, a 48% year-on-year increase, which beat estimates of 2.4 billion Singapore dollars, with total income increasing 35% to 5 billion Singapore dollars, raising net profit for the first 6 months of 2023 to 5.3 billion Singapore dollars. Wealth management AUM reached 320 billion Singapore dollars, a 9% year-on-year increase over 1H23, with net new money flows of 12 billion Singapore dollars driving revenue in consumer banking and wealth management to reach 2.1 billion Singapore dollars in the same period. Half of wealth inflows reportedly originated from North Asia. Following the Singapore vibe, OCBC, one of Singapore's 3 main local banks, saw its wealth AUM rise to 274 billion Singapore dollars, up 10% year on year, and wealth management banking income increased 30% year on year to 1.56 billion Singapore dollars, though wealth fee income fell 5.7% to 181 million Singapore dollars as client activity was subdued. Total net profit for 1H23 rose 38% to 3.6 billion Singapore dollars. Standard Chartered, a British financial institution, saw pre-tax 2Q23 profit of $1.52 billion, beating estimates of $1.37 billion, with its Asia business seeing a 39% increase over the same period to reach pre-tax profit of $1.3 billion. The wealth management division saw an operating income rise 9% to $495 million. That took pre-tax profit for 1H23 to US $3.2 billion, with $2.7 billion generated in Asia and $1.02 billion in Hong Kong alone. Its private banking business in particular has more than doubled affluent new money year on year, with new high net worth individual clients tripling in Hong Kong and doubling in mainland China and Singapore. As travel starts to resume and economic activities slowly return to normal, the lender expects to see a boost in its loan and wealth management businesses in the second half of this year. Further, the emerging markets focused bank has announced plans to open 3 new branches in Hong Kong to capture high net worth individuals in the Greater Bay Area as well as Southeast Asia. Retail business in the GBA has shown an enormous 80% growth, while ASEAN-related transactions have grown by 26%. The bank's recent expansion initiatives come after the opening of 2 branches in the past 2 years amid COVID lockdowns in the city. With 3 new openings, it is clear that the emerging markets focused bank is increasing its wager on mainland China and ASEAN. Other wealth managers and banks have been active, with Nomura Wealth Management, the wealth management arm of the Japanese financial institution, announcing plans to hire a further 40 private bankers in Asia and the Middle East over the next 2 years, bringing the total to 135 as it aims to increase its AUM from $15 billion to $35 billion by May 2025. EFG, a global Swiss private bank, has hired a clutch of former Credit Suisse bankers and is expanding its Asian business, adding them to the 30 previously hired in the region as it looks to add 100 bankers to its global headcount in 2023. Citi Global Wealth, the wealth management division of the US bank, launched a credit card exclusively for its ultra-high net worth investor clientele to reflect the fact that internal research from the financial institution shows this level of investor seeks experiential and wellness benefits. The card, called Ultima, provides holders with a dedicated lifestyle relationship manager, access to various golf courses, resorts, vineyards, etc. across the globe, access to Michelin restaurants, and curated wellness retreats. This version was launched in partnership with MasterCard, and an earlier iteration was launched in Singapore in 2010. The bank joined several insurers who have launched similar lifestyle offerings. Regarding markets, Singapore is becoming a key one for several wealth managers, with HSBC recording record profits from its business unit in the city-state, and Knight Frank, a global property consultancy, notes that it is becoming an increasingly critical global wealth hub. Japan is another market of importance, with the recent white paper from Avaloq, a Swiss wealth management technology and service provider, noting that the market holds financial assets of $14.4 trillion, much of which is largely untapped by global players, though accessing this pool of wealth will require a change in focus to a more digital mindset. Finally, India's private banking and wealth management market reached assets under management in excess of $500 billion at the end of 2022, as per data from Asian Private Banker. Though wealth is concentrated in a small number of wealth managers, and foreign players have struggled to penetrate the market. With Asia driving inflows of net new money, wealth management revenue and pre-tax profit, along with other KPIs for several banks, coupled with the increasing wealth of the region and technological change, substantial growth in assets under management is available for local, regional, and global wealth managers and private banks. The acquisition of Credit Suisse by UBS is leading to opportunities in securing talent and clients, and reported cultural issues resulting from the integration of these two entities mean these opportunities are likely to persist. Over to Singapore. The Monetary Authority of Singapore, the Lion City's central bank and primary financial regulator, has released a consultation paper for a new single-family office framework that would enable the authorities to better monitor anti-money laundering risks within the industry. As family offices in Singapore have ballooned over recent years, from 400 in 2020 to 1,100 in 2022, regulators are starting to see a need for tighter supervision of money laundering and anti-terrorism financing activities. Under the proposed framework, all SFOs will have to be incorporated in Singapore and maintain business relations with at least one of the MAS-regulated financial institutions so that AML checks can be conducted. All SFOs, regardless of ownership structure, would now be assessed based on the same criteria for licensing exemptions, replacing the current case-by-case framework. Additionally, operating single-family offices will have to meet annual reporting requirements to the central bank on items such as assets under management and key particulars of the single-family office. While the proposed framework is under consultation until September, the new framework is planned to be implemented in a transitional period of 6 months for existing SFOs in Singapore to comply with the new requirements. Once implemented, operating single-family offices will have to send MAS a notification indicating that they have met the new requirements. Up to Hong Kong. Hong Kong securities regulator, the SFC, and de facto central bank, the Hong Kong Monetary Authority, have issued a joint circular outlining how intermediaries should handle suitability obligations when dealing with sophisticated investors, in accordance with their higher net worth and, supposedly, greater financial knowledge. Intermediaries will adopt a new streamlined approach for dealing with SPIs, enabling them to customize point-of-sale procedures according to the individual circumstances of the specific SPI. To assess if an investor qualifies as an SPI, intermediaries are to rely on onboarding information or KYC reviews. If the individual qualifies as an SPI, intermediaries no longer need to match the SPI's risk tolerance level, investment objectives, investment horizon, or knowledge at a transactional level with products available to them. Instead, they can offer upfront information about product characteristics and risks while continuing to uphold proper conduct standards and manage related risks. With the new measures in place, it is expected that client experience will be greatly improved for targeted individuals. To qualify as an SPI, an individual must have a portfolio of at least 40 million Hong Kong dollars or net assets excluding the primary residence of at least 80 million Hong Kong dollars, whilst relevant knowledge and experience can consist of pertinent degrees and qualifications, at least 1 year's work experience in the financial sector of Hong Kong or other regulated jurisdictions, or have transacted complex products at least 5 times in the last 3 years. Hong Kong's Private Wealth Management Association was, understandably, very much in favour of the development. Next up, Hashkey Exchange, a virtual exchange in Hong Kong, and OSL, a digital asset platform, have become the first licensed digital asset trading platforms to offer retail services in the SAR, having received upgraded licenses from regulators. The exchanges are now able to offer an expanded product suite to customers, both professional and retail investors, around the purchase and storage of digital assets. Notably, the permissions under which the two firms are operating are reportedly not the Virtual Asset Service Provider license, which no applicant has received thus far. Instead, the two companies received upgraded versions of their current Type 1 and Type 7 licenses, which pertain to dealing with securities and providing automated trading facilities respectively, the upgrades to which permit services being offered to retail investors. Hashkey emphasized the importance of safety, noting that the platform was designed and developed from the outset in accordance with regulatory requirements to achieve native compliance, with a focus on multi-layered protection of user assets, with funds kept under segregated accounts and separate from platform operations. Hashkey will begin by offering Bitcoin and Ethereum to its retail clients, and expects 1 million retail users to be registered on the exchange by the end of 2023. OSL will offer access to the same two cryptocurrencies as Hashkey. Under the recently introduced digital asset regulations, retail investors in the SAR are limited to trading crypto assets which are available on at least 2 recognized investable indexes. The SFC has reportedly received dozens of inquiries from crypto companies, including many from mainland China, which has effectively shuttered its crypto industry, though Binance, the world's largest crypto exchange, reportedly did $90 billion worth of business in the Middle Kingdom over May 2023, despite supposedly leaving China in 2021 when the crypto trading ban came into effect. Mainland Chinese crypto exchanges like OKX and Huobi, among others, have publicly stated that they will apply for the new licenses and have started onboarding retail clients whilst they become compliant under the new regime. Several banks are involved with the crypto exchanges as well, with Standard Chartered partnering with Hashkey, ZA Bank, a digital bank in Hong Kong, reportedly working with crypto exchanges to proffer their services, and DBS also seeking to offer crypto services to its clients. The Special Administrative Regions HKMA had communicated to banks in the territory, including Standard Chartered and HSBC, that they should take on digital exchanges as clients, and that their due diligence processes should not create undue burden on the exchanges. With Hong Kong pushing hard to become a global digital asset center, how these developments assist in that regard will be interesting to see unfold. Moving on, to realize its Middle Eastern ambitions, namely in attracting wealth from sovereign wealth funds, corporates, and family offices, industry commentators note Hong Kong will need to create a talent pool with relevant skills or import talent with the requisite skills, specifically individuals with Arabic language capabilities and Islamic finance knowledge. Such a move to develop talent would be a radical shift for the SAR, which has traditionally relied on cultural and language skills geared towards mainland China and acting as a connector between it and the West. Potential solutions to develop such talent include targeted incentives to attract people with needed expertise to the territory, or secondments by Hong Kong firms to send staff to the Middle East. With the Islamic finance industry forecast to reach $4.95 trillion by 2025, up from $2.2 trillion in assets currently, and Hong Kong's aforementioned ambitions to attract wealth from the Middle East and act as a conduit for investments into mainland China, the financial incentives for a successful talent development program are likely to be substantial. Hong Kong previously tried to become an Islamic finance center back in the mid-2010s, which saw 3 sukuks issued in 2014, 2015, and 2017 respectively, off the back of an Islamic finance roadshow held in 2010, before seemingly spluttering to a halt. This time, of course, may be different. And now to China. Deteriorating geopolitical conditions and fraying diplomatic ties are encroaching on China's asset and wealth management industry, both in terms of the ability of foreign firms, for now USA ones, to invest in the Middle Kingdom, and for Chinese funds to engage in US dollar fundraising. With regards to foreign asset managers investing into China, August 1st saw the chairman and ranking member of the Select Committee on the CCP issue letters to MSCI and BlackRock, an index provider and the world's largest asset manager respectively, on their investments into China, specifically pertaining to whether these investments were directed towards blacklisted Chinese companies which threatened the national security of the USA or supported the CCP's human rights abuses. The letter to MSCI centered around investments into over 40 Chinese companies via 5 indices the firm offers, whilst the letter to BlackRock was directed towards the $429 million in direct investments in over 20 Chinese companies across 5 funds the firm had made. The Select Committee is requesting a range of information to outline the reasoning behind the investments into the specific companies, along with policies, procedures, and related guidance documents relating to conflicts of interest and how the respective oversight committees and other governing bodies applied such policies, if at all. Separately, the head of the House China Committee has urged President Biden to widen proposed limits on investments in China to include equities and bonds, expanding the current scope of direct investments from private equity and venture capital firms. The move to request information and material from MSCI and BlackRock, as well as raising the spectre of subpoenas should said information and material not be forthcoming, follows the investigation of several US VC firms and their funding of Chinese technology companies, announced in July this year. The developments come as US dollar fundraising for China-invested private equity funds has collapsed in recent years, falling from a high of $48.88 billion in 2021 to $1.45 billion as of end June 2023. There has also been a substantial drop in Chinese investment into the United States of America, falling to a near 2-decade low, with current activity amounting to $200 $221 million US dollars, down from $3.4 billion US dollars at the same time last year. Total outbound Chinese investment in the year to date amounts to $12.2 billion US dollars, substantially lower than values seen in recent years. This has led to several foreign banks being nearly completely shut out of recent Chinese investment activity, and the investment banking space is now dominated by local firms. Whether matters improve across all factors or continue to deteriorate remains to be seen. Up next, regulators in China and Saudi Arabia are reportedly in discussions on a China-Saudi Arabia ETF Connect program, with the Shenzhen Stock Exchange and Saudi Tadawul Group, the operator of the Saudi Stock Exchange, in negotiation. If successfully launched, the move would see the ETF Connect scheme join those which China has entered into or initiated between Hong Kong, Japan, South Korea, and Singapore in recent years. As of June this year, there were 886 ETFs with $256.8 billion US dollars in market capitalization, as per data from Morningstar, listed on the Hong Kong and mainland China bourses. The Saudi Stock Exchange, by contrast, had 8 ETFs, though its total market capitalization is $2.7 trillion US dollars, one of the largest for emerging markets. Hong Kong Exchanges and Clearing, operator of the Hong Kong Exchange, is in separate talks with its Saudi counterparts for a similar program, part of the recent efforts of the SAR to bolster its role as a channel for Middle Eastern funds to flow to China. STG and HKEX signed an MOU in February this year to explore cooperation across a range of areas, including fintech, ESG, and cross-listings. Outside of the ETF Connect program with Hong Kong, the other ETF schemes China has entered into have had rather lackluster results. Should the agreement with STG come to pass, it will be interesting to gauge its success and whether an agreement with Hong Kong is included or separate from any final scheme. Over in China fund news, in public funds, new fund sales in China over July saw fundraising of just under 60 billion RMB across 76 products, the third lowest amount seen in the last 4 years. This follows total fundraising of 528.6 billion RMB across 609 products seen over the first half of 2023, the lowest amount since the first half of 2019. Within the 76 funds launched, 10 amounted to over 60% of total fundraising, with 5 of these, all bond funds, seeing fundraising of 3 billion RMB or more. A further 3 ETFs raised 2 billion RMB each. Circa 25% of the funds launched saw fundraising of less than 50 million RMB. The number of liquidated public funds has also increased over 2023, with 143 funds being shuttered compared to the same period last year, the second highest figure since 2018. Whilst increasing industry competition is a factor, the challenging fundraising environment is also a significant contributor in the wider market, and China's ETFs have seen AUM reach record levels as the products see substantial inflows from government policies designed to stimulate the economy. July saw CSI 300 ETFs receive net inflows of 19.4 billion RMB, bringing total market capitalization to 153.3 billion RMB, and all Chinese equities ETFs now have assets of 1.6 trillion RMB, up 320 billion since the end of 2022. 33 of these products boast assets over 10 billion RMB. ETFs may receive a further boost as security firms change their business models regarding public fund sales due to the aforementioned changes to fees in specific mutual funds. Chinese brokerages, which have stakes in FMCs, have been encouraged to change their business model to sell more ETF products, as well as fixed income funds, in order to diversify their investment management business. Building investment advisory services was also floated. One spot of good news for securities firms is the upcoming change to the minimum ratio of funds which brokerages must set aside in cash settlement accounts, which will be reduced from 16% to 13% from October. This follows previous lowerings of the limit, from 20% to 18% in late 2019, and again from 18% to 16% in April 2022. The move may unleash between 30 to 40 billion RMB in cash, which the brokerages may help guide to products they offer, including their investment advisory services and pertinent funds. Recent data shows 33 securities firms having stakes in 52 fund management companies, with 24 of these being majority stakes. Brokerages also account for around 25% of China's public fund sales. Research indicated that the worst affected firm would see a 10.5% decrease in profits following the implementation of the new fund fee limits. Over in private funds, the year to date has seen over 2,000 private funds deregistered as regulators increase their efforts to remove those which are seen as fake and badly run from the industry. The number nearly exceeds that from all of 2022, which came to 2,210. Circa 80% of the funds removed, 1,616, were under the most severe category, that of declassification by AMAC, a classification reserved for those which are convicted of regulatory breaches or illegal operations. The number in the year to date under this category is nearly twice that of last year, which came to 843. The news comes as AMAC recently issued new directives targeted at reducing private fund registrations, new administrative rules, and a shifting of some responsibilities to private fund custodians. The proposed framework, introduced by the State Council, will take precedence over the current measures issued by the China Securities Regulatory Commission and aim to align the regulations with the Securities Investment Fund law, bridging the gap between the two. The new framework comes as China's private fund industry rapidly expanded with insufficient supervision, with June 2023 seeing 152,322 private funds registered in China, according to AMAC figures. Tighter oversight and consolidated rules will limit the scope for private funds to engage in illicit activities, including illegal fundraising and market manipulation, which have previously been conducted without consequence. Currently, one area remains which the new framework has left unaddressed, that of fund custodians and their roles and responsibilities in safeguarding investor interests. There is ongoing debate on the extent to which custodians should be responsible for investors' losses caused by the wrongdoing of fund managers. However, for funds with custodians, said custodians will have to establish strict mechanisms that will ensure the independence and safety of assets under their custody. Moving forward, more policies surrounding venture capital funds and government-owned funds are to be introduced to tighten regulation and support the development of VC funds. CSRC will also be amending its 2014 regulations in accordance with the new framework and will apply different supervision standards to different funds. A previous effort to rein in and regulate private funds occurred in 2014 when they were brought under the purview of AMAC, and AMAC issued new rules impacting private funds earlier this year, which impacted their minimum upfront capital. Further, following the latest Politburo meeting, Chinese securities regulators have committed to implementing new capital market reforms in the second half of this year, with the aim of increasing foreign capital access to the nation's financial markets. The latest promise of policy support comes as the Communist Party seeks to drive further economic recovery amid a tortuous post-COVID recovery. In response to the new promise, CSRC has released a statement on its commitment to fostering the robust growth of platform companies and ensuring secure financing channels for real estate firms in the capital markets. These statements echo similar ones made during the recent Lujiazui Financial Forum held in June this year. Though with increasing geopolitical tensions and greater regulatory scrutiny being applied, how attractive the industry remains to foreign players will be interesting to see. In China fund manager updates, over half of China's top 20 fund management companies boosted their retail fund assets under management over 2Q23, further entrenching their position in the circa 28 trillion RMB public fund market, with a combined non-money market fund AUM of 9.04 trillion RMB in the top 20 firms. The growth comes as new fund sales fell 22% over the first half of 2023 compared to the first half of 2022, amounting to 528.6 billion RMB, the lowest amount since the first half of 2019. Industry analysts see the continued dominance of the largest FMCs, combined with recent regulatory mandated fee cuts to specific funds, which could make it harder for smaller funds to survive in the industry. Within the top 20 FMCs, 12 increased their non-money market fund AUM, with 9 boosting it by more than 10 billion RMB. At the other end of the spectrum, 3 FMCs in the top 20, including eFund, China's largest fund management company by AUM, saw its assets under management drop by circa 25 billion renminbi. The news follows the revelation that 5 Chinese fund management companies now boast assets under management in excess of 1 trillion renminbi in total mutual fund AUM, and another 3 boosted their AUM by circa 60 billion renminbi over the second quarter of 2023. The 5 firms, eFund, GF Fund Management, China AMC, China Southern Asset Management, and Tianhong, along with the next top 15, manage 17.4 trillion renminbi in assets. How this concentration plays out in the FMC sector, and whether the foreign firms who recently took controlling stakes in joint ventures or who have launched their own 100% owned entities will be able to break into it, will be interesting to see. Next up, the FMC joint venture between Amundi, a French asset manager, and Agricultural Bank of China, a Chinese state-owned bank, has seen net outflows of over 10 billion euros over the first half of 2023, following the 6.7 billion euros in outflows it suffered over 2022. This drop led to the overall Asia business to see assets under management fall by 3.8 billion euros over the first half of 2023, in contrast to the 26 billion euros in inflows it saw over the first half of 2022 for the region. The outflows come as the French asset manager looks to establish a 100% owned retail fund unit in China. Moving on, China Merchants Asset Management, the asset management subsidiary of China Merchants Securities, which is the securities and brokerage arm of China Merchants Group, has reportedly received regulatory approval to begin managing public funds 7 months after the application was filed. With the granting of this license, the China Merchants Group now has stakes in 3 fund management companies, the maximum allowed under regulations implemented in May 2022. Having received the license, China Merchants Asset Management now has 6 months to finalize its internal systems, infrastructure, and processes in order to manage public funds, something that foreign asset managers have also experienced as they undertook the process. Up next, HSBC's insurance brokerage unit in China has received regulatory approval to undertake securities investment fund sales, the 5th such insurance agency and brokerage firm to do so, though there is outstanding preparatory work required before fund sales can commence. The news comes as the British bank has also applied to be a fund custodian, the application for which was filed back in 2020 and is still pending, and is seeking to acquire a controlling stake in its fund management company JV with Shanxi Trust. Further, HSBC's FMC JV and the recently renamed public fund unit of Morgan Stanley have each received their first QDII investment quotas, enabling them to launch funds in China with an offshore investment focus. Each unit received $120 million under the cross-border investment scheme, the higher end of the recent issuance, which saw $1.84 billion issued across 19 fund management company recipients. QDII funds have performed well compared to domestically focused funds, with 95 of the 252 QDII funds seeing gains of 20% or more in the year to date. And finally, foreign fund managers looking to establish a 100% owned public fund entity in China, or who are in the early stages of doing so, are advised to be patient and to stick to their long-term strategy. With 9 100% foreign-owned FMCs and 5 foreign majority-owned FMC JVs approved in the market, foreign firms are increasingly taking their onshore destiny into their own hands, though those trying to build Rome in a day are likely to be disappointed. Sufficient capital injections and patiently growing onshore businesses are seen as the keys to building a sustainable fund management business in China, and some industry analysts see a 10-year runway before operations are profitable. The right distribution strategy, talent pool, and trust of external management were also seen as crucial in this success. With what is seen as an increasingly stringent regulatory environment, rising compliance costs, and a deteriorating geopolitical situation, no doubt some fund managers are either reassessing their onshore operations if in the market, or reevaluating their desire to be in the market if not. So, that is what we saw for this episode in terms of the key headlines and developments for for Asia Pacific's asset and wealth management industry. Do let us know your thoughts in the comments below, and if there was something that we missed, point it out to us. A special thanks to Sam for helping with this episode's script and research. Thank you all for watching. Hope to see you next time.